business comes to talk.
Welcome back to Midday Majlis with myself, Sahar Mushtaq. Before the break, we touched on some of the challenges professionals face when it comes to making their money work smarter. And to help us explore this further, joining us in the studio is Fadi Habib, a financial markets educator and personal finance consultant. Fadi will share practical advice, strategies, and tips to help navigate investing risk and making the most of your financial decisions. Fadi, it's really great to have you with us.
I'm very happy to meet you finally, Sahar. How are you?
I'm very well. How about you?
Very good. Came to Dubai yesterday and I'm enjoying staying at Dubai.
Nice. So, Fadi, let's just kickstart the discussion with one question that comes to my mind all the time. I see people making good amount of money, okay? But then again, there is something that is making them kind of not, grow their wealth in a way. So they are making money but spending money. So what's the biggest reason that high earners still don't build real wealth?
High income and wealth are two separate things. If you have high income, this does not mean that you're wealthy by any means, because there's spending and there's some other stuff that goes into the equation. So the wealth comes from taking your income and getting assets that can grow with time or give you income, additional income. This is the equation to wealth. But if you have high income and all what you're doing is spending, and the pressure on everybody to spend is humongous. Inflation everywhere is rampant. So whatever you used to pay $10 in today, you will have to pay $12 tomorrow and $15 tomorrow. And usually, income growth does not match inflation. And this is just to get by. If you want to build wealth, you have to translate that into getting assets that will grow. We talk about real estate, we talk about stocks that give dividends or stocks that grow. But that's the equation to wealth. So high income does not mean wealth. It's two separate things.
Right. So it does not actually guarantee wealth at all, but it's the way to manage it and to grow it. That's
Correct.
what matters,
Yeah.
right? And moving on, sometimes one small change in how you think about money can actually make a big difference. So, what's the first financial shift you actually recommend to break out of the paycheck cycle?
So it's a paradigm shift. It's a mental shift. You don't have to do anything, but you have to think about it and understand and get to the belief that you have to go and venture into the world of investing. Because if you don't, if all what you have is your high income, that won't cut it. And very, very soon, in 10 years or so, you will know that you're not really, your net worth is not increasing. So it's a paradigm shift. It's to understand that this is important. And if you understand that this is important, few things will translate to. Number one, everybody spends, and if they have money, they maybe will invest. This has to change. You invest in yourself first, you invest first, and you spend what's left. That's that's a shift. You treat investing like a bill. Like everybody goes and pays all their bills first, and then if there is money left, then they think of, oh, okay, how should I invest this in? If you really depends on how strong your belief in the fact that the way to wealth is investing. People who are taking seriously, they pay themselves first as if it's a bill, as if it's a utility bill, as if it's a car bill, something that it's not negotiable, that has to be paid. And if you do that, you will see the results. But it's more of a mental shift. It's not really actual work.
Right. So it's actually something which is like a small change or a strategy that you need to kind of introduce to yourself when it comes to investing for the financial freedom to follow.
I do recommend, I always say that every time, read this book, Cash Flow Quadrant. I really recommend it. It helped me with this paradigm shift. It told me that there are 4 different ways to make money. One of them is being an employee, and it's not really the best way. And introduced me to the self-employed business owner and investor. So it's more of a mental shift. It's more of thinking about it and understanding and believing, or not, that the road to wealth is by investing. It's not by saving or by high income. A lot of high income people are broke. because they spend a lot. Like you've heard a lot of very different,
The
very,
bigger
very,
the paycheck, the more
exactly. A lot of
expenses.
very, very wealthy people, if you're spending more than what you're getting, it doesn't matter how much you're getting. If you're getting $10,000 or $1,000 or $1 million per month, if somebody's getting $1 million per month and they're spending, like they're buying cars and they're buying yachts and they're buying stuff that is worth million, 1.1 million per month, they will end up not wealthy at all. They will be poor. They will go bankrupt. And the story is all around us. So it has nothing to do with income. It's what are you doing with your income that determines whether you're going to be wealthy or not.
And lots of people actually believe in investing into properties because they find it safe and it's hard for them to actually invest into stocks. So, if somebody already likes real estate, how should they think about adding stocks to their investments?
I love both asset classes. I'm in both. I started in real estate, and 15 years after that, I went into stocks and options, but I do both. So there's fundamental difference. It's not that there's one that is really better than the other, but understanding the differences helps people. Number one, stocks is very liquid. When you put your money, if you put $1 million in a property, let's say, or $100,000 in a property, to get this money out, usually it's not that easy. Either you have to sell or do something called refinance. You have to go put an application, and some other person will say whether you should get this loan out of the equity of the property. When you have stocks, it's very easy. It usually takes 48 hours to put money into your broker account or take it out. So there's an element of liquidity that is good for stocks. In real estate, it's very good because you can use leverage. I will never buy property except when I go to a bank and get a mortgage because it gets me much more ROI. So I'm okay to borrow to invest in real estate. This is disastrous in stock. We should never use margin, and we can talk about that later. We should never use margin in investing in stocks. So there's the advantage in real estate that you can use margin because it boosts your ROI. Another fact here is that both of them, you have to be looking at long term and you have to be looking at them as businesses. So they're not lottery tickets, and there's this tendency with us people going into stocks to treat it like a casino. But the right way of looking at both is that they're both, you're looking at long term and you're looking at it as a business.
Right. And so every investment actually comes with its own pros and cons all
Correct.
the time. And if you're a busy person, you want what actually fits your life and your lifestyle, right? You can't be doing like 10 things at a time, investing into property, investing into, the other stock markets
So
and
it
things.
depends on the way you're investing. So with both stocks and real estate, some people can invest in a way whereby they don't spend a lot of time. And so, for example, in real estate, there are different ways. There is the buy and hold. You can buy something and rent it. Even with there's buy and hold. There is fix and flip, meaning you get something and you renovate it from the inside out. And there are different levels of that. Some people go for the really, really bad, deserted place, really run down. So they have bigger projects to lift the value. There's something called lease to own. And even with all of these, there is, when you buy something to rent it, for example, you can buy it in A location, B location, or C location, meaning the type of location. Is it nice? Is it good? Is it bad neighborhood? And even with that, you can target A-level tenants, B-level tenants, C-level tenants. So based on how you structure your investment, you need to be very involved or not that involved. For example, in my real estate, for example, I target A areas and A tenants. So really, I don't need to spend a lot of time because the tenant that I have, and I spend a lot of time trying to get good tenants. I don't spend a lot of time managing the tenants because they are sometimes better than me in taking care of the property. So it depends on the way you invest. It will dictate how much you're involved. If all your properties are in rundown areas with C-type tenants, you will be involved all the time, right? If you don't have a system to maintain your properties, you will get these calls to repair or disasters all the time. So it depends on the way you invest in real estate or stocks, not that one is better. Just in each one of them, there are different ways to invest. In stocks, if you're a day trader, you will have to look at charts all day. But if you're a long-term investor, which I kind of, I don't like the day trading mentality. I don't think it's the right way of approaching the market. If you're more of a long-term investor, you will not have to put a lot of time, and if you have a good strategy, you should not be that involved. I am telling you, I'm traveling all the time. I can run my real estate portfolio and my stock portfolio without intensive time because I designed it to be this way.
Really?
Yeah, because like if I have a stock in Apple, am I really working in Apple? All the people in Apple are working really hard for the business to be better, so that the stock becomes better, so that
Right.
investors like me can get better. But I don't have to look at the chart of Apple all day. I don't need to. I'm not a day trader. And look at Warren Buffett. One of the things I actually learned about Warren Buffett is that he almost has empty schedule. He does not, he's not busy at all. And his ROI in the last 60 years was like 6.5 million because he's patient. It's not by working, it's just by working smart, by designing
So
what you want to do.
it is actually about making the right practical choices.
Correct. And choosing wisely without greed. Like the way you choose how to invest will dictate a lot of your results and the way you go about it.
Right. And you've just mentioned that some people think that investing means staring at the charts all day long, but that's not true, right?
not
So
true.
what does responsible investing actually means?
Okay, so responsible for me means, number one, understanding that it is not a casino. Like if you go to a casino thinking you're investing, that's not responsible. So number one, understanding that whether you're investing in stock market, and mainly for the stock market we're talking about now, and real estate, that you are buying and selling businesses. It's not a casino. It's not a game. You have to be risk averse. That's being responsible. You should not be after get rich quick schemes. All of that for me is very irresponsible. Like you're not, like sometimes people approach it as if they are playing a video game. Like, they're getting the thrill of it. You should not be getting the thrill of anything here. So looking at it as a long-term venture, understanding that you're investing, meaning you have to be buying assets, whether it's a real estate or a stock, that is really good quality. You can't be a serious investor and you're just buying anything, thinking that anything will go up. Responsible means that you understand that it takes a little bit of time and that you're not going to buy anything today and will be a millionaire tomorrow. It just doesn't go this way. And it's quite naive if you expect it from the market. And the fear here is that you're going to be losing your capital if you go with this.
So it's very much a steady growth process.
Steady growth and treating it seriously like a business. It's not a game. And a lot of people treat it as a game. And also understand that with really, really high ROI comes really, really high risk. That's important because part of your responsibility is not to get involved in scams. And with people who think they can get rich very quickly, they're usually very prone to get used by scammers.
Right. And that actually makes me ask you my next question. Those people who actually think that they want to make money overnight, they do not really have a plan and strategy in place, right?
No.
And that makes it very complicated for them. So how do you build a plan that doesn't require watching markets all day?
So number one, the shift, again, it's a mental shift, is that you need to be thinking that you're going to be making money in the long term, not short term. So you got to give up the idea that you can. It's as if buying a house and think it's going to double tomorrow. It's crazy. And if you pursue it that much, you will get somebody that will convince you that this will happen if you just buy their house and you will get scammed. So number one, understand and shift that you can make a lot of money long term.
But
Okay,
there
so-
is work that has to go in beyond just
Correct.
manifestation.
But most, because I talk to a lot of people, I see the biggest problem is just number one, is that
Right.
they actually believe they can make money quickly. So it doesn't matter what I say afterwards. They just can't go after, beyond step one. So number one is a mental shift that give it up. You can make, so that's number one. Number two, Invest in good quality stocks because the market is like a mirror in the long term. The price will match the value of the stock in the long term. In the short term, we can talk about that. In short term, has nothing to do with the value of the stock. Forget about short term. Like price goes up and down based on news, and we can talk about how does it go between short term and long term. But understand that the price will mirror the value in the long term. So if you focus on good quality stocks, you will benefit on the long term. And we can define what is a good quality stock as well to make things clearer. But good quality stock meaning a business that is making money, and there's some criteria that I go through to figure out what is a good stock. Basically, if you have a business that is making profit and the profit is going to increase going forward, the value of the business goes bigger. It just makes sense, right? The same as an apartment building. If the rent this year is, I don't know, $10,000, the value of the house will be a multiplier of that. If the apartment building next year, the rents have increased to 20,000, then the price of the building will go up. So it's a business. You need to treat it as a business. So the stock is the same thing. If the company is profitable and the profits are going further and increasing, then in the future, regardless of what happens today, because in the short term, the prices
Fluctuate.
and it's not just fluctuate, it has nothing to do with rationality. The price, maybe we can jump into that if you give me like 2 minutes to explain how do prices change in the short term. Think of it as a tug of war, like a rope, and on one side there are the people who are bullish. They think the stock is good, so they want to buy more. Okay, and the other side there are the bears, or the people who don't like the stock, they want to sell it.
Right.
So in this tug of war, if the bulls or the people who are buying win, they are more than the sellers, the price of the stock goes up. And in the same situation, if the bears or the people who don't like the stock or selling are more than the buyers in terms of volume and quantity, then the price of the stock goes down. The main factor, the main driver of this short-term tug of war is emotions, it's mood, it's fear, it is speculation. Somebody wants to buy because they think it's going to double tomorrow. All of it has nothing to do with rationality of how the good the stock is or not, and also sometimes with manipulation. So in the short term, the way I try to explain it to people, it's like a teenager drunken party. People are just buying and selling. It's as if, think of somebody who's drunk, who's waking up in the morning and assigning prices to the stocks. It has nothing to do whether the stock is good or not. It's like a popularity voting machine. So a stock can be really good, but for some reason it's not really that popular today, so the stock goes down.
Right.
So the price and value are completely separate, are completely different in the short term. However, in the long term, like one of the things I learned from Peter Lynch is this concept. On the long term, the price and value merge, come together. Because on the long term, it's like a weighing machine. It really weighs the value of the company, and the price matches that. But in the short term, it's just crazy. So the people who are day traders, who want to capitalize on this emotion, it's very random. It's very hard. It's not a system. So for me, focusing on long term, forgetting about the news on the short term, buying good quality stocks is the way to go.
Right. And sometimes stocks go up for the wrong reasons as well. And people confuse hype with the real value
Yeah.
of the assets and stocks. So, what's the difference between a stock getting up because of hype versus the fundamentals?
Correct. So if we define what is a stock, then it becomes very simple. A stock is a share of a business. You're getting a part of Apple or Facebook or Amazon or SAP. So the main objective of business is to make profit. It's not a charity, right? The main objective of the business is not to make good products, because they can make good products and they are losing money and they will die at some point. So, of course, they have to make good quality products, but that's how they make sure that they stay profitable. So if we know that the business the main objective of a business is to make money and profit, then understanding that if they make more profit, more consistent profit, and more profit, then the price will match the value. The value of the company will be more, and the price will be more. But we're talking about long term, 5 years plus. This has nothing to do with the price of the stock in the short term. Like short term in the stock market means anything less than 2 years. So, an example I always like to say is Meta, which is a good stock, pumping a lot of profit and revenue. And I think in 2022, it went down from $400 to $83. You lost 80% of its price, not value. The value is still intact. But just because people are afraid because of whatever, they can be afraid of anything, COVID, a war in the Middle East, a war in Ukraine and Russia, this will all affect different things, and people will be afraid and will sell. So in the short term, basically the point that I'm making is that the price of a stock going up and down in the short term has nothing to do with how good it is. Nothing. So it is very important to understand what is a good stock, how to find a good stock, and you need to have a long-term view.
Right. And we see a lot of them going after the short-term buzz.
Yeah, well, yes, which is exactly the opposite of what they should do. Because in the short term, it depends on the mood swings of people. It's completely random. So when you try to capitalize on something random, your chances of hitting it, because some people make money short term sometimes, because it's so random, like 50% of the time you can benefit from that, 50% of the time you lose, and overall very inconsistent, and most people lose money when they focus short term. It's again, same thing. If you buy a condo or an apartment today, and you want to sell it next month because you think you're going to make money, you'll end up losing because there's transaction fees and lawyers and real estate people. So the responsible thing is to look long term.
Is to be patient.
Yes. Yeah. One of the questions I wanted to always think of, and I got the answer very lately, is when do you make money? When you buy or when you sell?
Interesting question.
Yeah, the answer is you pay money when you gain when you wait. Of course, you need to buy at the right time and sell at the right time, but most of the money is made. If you look at Warren Buffett, you will get that. Most of the money he made is waiting. He doesn't go in and out of Apple every day. He stays with it, and he's so convinced that it's a good stock that he doesn't care if the price of the stock goes down. One of the things I learned about Warren Buffett is that when he buys a stock, everybody, when they buy a stock, they want it to go up. Warren Buffett said, when I buy a stock, I actually hope that it goes down. Because he has
That's very unusual.
No, but think of it this way. It's part of the philosophy. He has no intention. He does not want to sell it tomorrow or after tomorrow. He wants to stay with it for years and years and years. That's how he knows he's going to make a lot of money. So if you're with this mentality, you want the stock to go down because you want to buy more.
Right.
Okay? And this is not a marketing thing he does. He's actually, when you see the interview, he believes what he's saying. He knows that this is a really good stock. Look at how many years he has Coca-Cola or Apple. He stayed with them for years and years. And in these years, sometimes they went really down. And he capitalizes on that. When everybody is selling, he's buying.
Right. And that actually, brings me to my next question. We can connect it to what you've said. So picking a stock can actually feel very overwhelming at times. And so what are the top 3 things you look for before buying any stocks?
So it has to be a good quality stock. For me, the number one and the most important one is it profitable? So I look at the EPS, earnings per share. Earnings is the profit. Is the company making profit or not? You will be surprised to know that half of the 6,000 companies, almost half of the 6,000 companies in the US market are not making money. So they're completely out. So I look at how much money they make in terms of profit. I look at their revenues. I not only want them to be profitable with a certain level of profitability, I also want to see history for the last at least 5 years that the revenue and earnings are increasing. So I want to make sure that they are profitable for at least 5 years. So I don't invest in any new company, right? And then I also want to know that the earnings or the profit in the next 5 years is expected to grow. For example, just an example, there was a company called Blockbuster, which was very, very famous in Canada. I don't know if it was here. The way 10 years ago, if you want to watch a movie, is to go to this Blockbuster and rent a DVD or a Blu-ray. Okay? Probably more than 10 years, 20 years ago. And they totally missed that Netflix is out and everything is going digital. This company is no longer there. So they might have been profitable at some point, but their future forecast of earnings would not have been very good. So coming back, earnings, they have a lot of profit. They had a lot of profit for the last 5 years. I want to see that the trend is going up. I want to see that the earnings and profit and revenue will be continuing to go up for the next 5 years or 10 years at least. I want to see a very strong balance sheet, that they have a lot of assets, not huge liabilities, so their shareholder equity is solid and increasing. I want to also see that they have a lot of free cash flow. Companies with cash flow can do a lot of good things, meaning they can buy other companies, they can buy other technologies, they can buy back shares, they can invest in R&D. Very important. They need to invest. Like Apple, for example, they invested 10 billion trying to make an electric car, and they did not succeed. But they had money. Like, I see it as a signal of strength. They had money to put 10 billion in a project that I don't think it worked. But they were so strong that they were able to do that, right? Companies that don't have free cash flow, so there's a statement called free cash flow statement. I also look at, they have something called a strong moat. And moat is the ability, if a company has a strong moat, it's not easy for competitors to come and cannibalize or take their customers. For example, iPhone have a very strong moat. Apple, everybody wants to have an iPhone, even if...
Everyone is dying to get the newest release when it's out.
Exactly. And by the way, Samsung probably have better quality phones, but there's a moat has to do with Apple because of the ecosystem. It connects to my iPad, to my EarPods. There's this ecosystem and there's this cool factor that's called a moat. And companies...
And the trend has been set as well.
Correct.
For Apple.
So companies with strong moat, even in tough times and bad economic conditions, these are the companies that they can increase their prices and the people will still buy. So strong moat is very important. There are different ways of, there's different types of moat. Like if your company is using an ERP system, let's say called SAP, it's very hard, it's entrenched everywhere in the company, that even if you're not very happy with it, it's not very easy to change it. If you're using an accounting software in your company, it's not very easy to change the whole thing. Anyway, so that's another moat.
Right. So we will continue talking about that after a short break. And we do understand that focusing on a few key points can actually help you make better investments, better choices, and practical ones as well. So we are in conversation with Fadi Habib, who is the financial consultant, and we'll be right back. This is Midday Majlis on Mira Business FM. Welcome back. This is Midday Majlis with Sahar Mushtaq on Mira Business FM. We were talking to Fadi Habib, the personal finance consultant, right here before the break about simple framework for choosing quality stocks. And now, moving on, Fadi, let us shed some light on options as well. So options actually sound very scary when we actually talk about them. But really, they are just another way to manage risk as well, as you said earlier, and an opportunity. So what is an option in the simplest possible explanation?
Okay. They are not an easy topic, so I'll do my best to try to simplify it. But options, correct, is very risky if you don't know what you're doing. So I do advise people not to touch them if they don't know what they're doing, because it's a very easy way to lose money.
Are they only for experts?
No. If you learn it correctly, then it is not that scary. Like I do have a master class to teach people about it tomorrow, and there's 50 different ways to do options. I only focus on 2 low-risk ways. So in everything that you touch, there are, same as stocks, there are risky stocks, there are bad stocks, good stocks. So there are very different gamut of ways to use options. I only choose 2 low-risk ways. So let's talk about what is an option. Historically, in the 1600s, the farmers had a issue with when they are planting crops, they had no idea, like in May, they had no idea what will be the price because the price fluctuates all the time. How will they sell the crop in October? What is the price? And the people who were buying the crops had the same issue. How expensive that these crops will be. So they found out a way to say, in May, let's agree, me and you. Let's say I'm the farmer and you're buying the crops from me. So I'm going to agree with you that in October, you're going to buy it for each ton of whatever, tomato with $10. Okay, so we agreed in May that in October, we price fixed the thing at $10 every ton. Okay?
Right.
And then this propagated a little bit. In this first setup, I will have to sell it to you at 10, right? We already
As agreed.
As
Yeah.
agreed. And then somebody said, what if I don't, like as a farmer, what if I don't want to sell it to you at 10? And you said as well, okay, what if I don't want, I know we have this agreement, but what if at that time I found somebody else that will sell it to me at 9? Why would I have
Stick
to
to,
do, yeah.
yeah.
So they developed this something called an option, whereby you, Sahar, will have the option of buying it at 10 or not. Okay? So it's agreeing to buying or selling something in the future at a certain price, but you have the option. One person will get the option of the right to exercise the option, whether to buy or sell, and another person will have the obligation. And that's not very clear. Another way of explaining it very quickly is if you're a business expert and we're friends and I'm calling you all the time to pitch ideas to you and you give me your opinion. And I do that all the time. And then I wanted to formalize this agreement. So I can tell you, Sahar, let's agree that for the next month, every time I call you to pitch the idea, you have to take my call, okay? And for this agreement, only for the next month, I'll give you $10 today. In this setup, I bought the option of calling you, and you sold me the option of taking my call. You sold me the option that I can call you anytime. Do I have to call you? No. I have the right to call you, but I don't have the obligation to call you. You, as the seller of the option, you have the obligation to take my call. So bottom line is, it's an option, it's a choice. I have the choice of doing it or not. And
Just like any choices in real life.
correct, it's a choice. And for that, because you took the obligation, you actually got $10. So just a simple example of options, but we can do the same thing with agreeing to buying or selling stocks at a certain point in time. And for that, it's actually a great way to generate income. But you need
Right.
to learn it properly.
I think you've really simplified it in a very easy way out for us.
It is
for
not
the
easy at
audience.
all.
Yeah.
But,
It isn't?
It is not, but that's
But
a simple way of looking at it.
the way you've actually said it, it makes a lot of like sense and not sound so scary as we thought it is. So now, having you here in the studio, I know we have discussed this before when we took you online with us on Midday Majlis the other day for an interview. So we did touch upon the topic of risk management.
Yeah.
But I would like to also touch upon it today.
Okay.
So what are the most common mistakes that cause people lose money?
I always start with the mental aspect. The biggest mistake is that people sometimes forget that there is risk. With anything that has an ROI, there's a risk in place around it, lurking somewhere. Risk and ROI are a couple that cannot be separated. So first thing is just understand that it's there. When you cross the street,
They go hand in hand.
they go hand in hand. If you cross the street, there is risk. And we learned to mitigate the risk by crossing at the right place, by waiting for the red light to happen, by looking for cars. All of that is risk mitigation so that the crossing the street process becomes safe, right? So first mistake is that if you have no idea that there is risk. And usually this is combined with the people who think that they can get rich quick, and they go through very risky investments
By following the trends at
by
times.
following the trends and not thinking that there is risk. So understand that. So sometimes you need to cap your ROI. If somebody told you this will give you so much money very quickly, all what I'm hearing is risk because I'm trained. I know that this is kind of not normal.
So do you think here is where your own research comes into effect?
So number one is just to be skeptic, right? It's just it's a mental thing. There's no research yet. Like this is just the first thing is that you need to be a skeptic. You should not be trusting people who talk about money right away. Like I always start my master classes with, please don't trust anything I say. You got everything you need to think of, think critically, and put it to the test. So that's number one. It's just a flicker in your head saying, you know what, this doesn't make sense. Number two, you need to make your own research. You need to be looking at if this makes any sense. I shared last time how scams work in terms of like people get promised a lot of things. And so be skeptic, understand that risk and ROI go hand in hand, do your own research. If your gut feeling is telling you that this is good to be true, trust that, okay? Because you should not be putting your capital at any kind of huge risk at all. If like you are better without that. Like people paid a lot of prices for trusting things or trusting huge ROI irrationally. So go slow. I gladly leave highest ROI things that I'm not sure about. Like for me, if I have two stocks,
And not fall for the trap.
correct. And even if there's no scam, if I have two stocks, one of them have solid record for the last 10 years in terms of profit. The other one has a lot of hype in it, but just started today. But everybody's saying they're going to be great. I don't go for the hype of the one that just started today. Even if I might lose some opportunity cost because it might do very well, but I'd rather go for the ones that is more safe.
Right. Well, you know what, Fadi, we have so much more to discuss with you, but unfortunately, we don't have time as we are running out of time and we do have to go for the news in a bit. So, any final advice?
Read the cash flow quadrant, watch all the videos you can for Warren Buffett and Peter Lynch, and they will change some of the things in your head to the better.
And maybe we can connect with you online next time when you're back in Canada and talk more about it.
That would be great.
About the lessons you have actually learned from them.
I learned a lot from Warren Buffett and Peter Lynch. They're great. They're great.
We wish you a great stay here in Dubai. I think you're here for another 2 days.
2 days, yeah.
Right. So, and then it's a long flight back home.
Yeah, I'm going to Riyadh.
You're going. Oh, that.
For another masterclass, and then back to Cairo, and then go to Canada after that.
Okay, interesting. Well, enjoy your time in Riyadh, and we wish you safe travels back home.
Sahar, thank you very much. Thank you.
Thank you so much for being here today. And that brings us to the end. And one final takeaway that we actually have from our discussion today is that whether you're just starting out or already investing, the key is simple. Understand your money. Focus on long-term growth, manage risk, and make choices that actually fit your life well. And that brings us to the end of today's Midday Majlis. I'll be back with more engaging conversations and interesting discussions. Do not forget to like and subscribe to Mira Business FM. Until next time, this is Sahar Mushtaq signing off.